Welcome to the XUCPA channel. Today we have some critical news that we want to share with business owners, especially businesses who undertake continuous R&D activities. The R&D tax credits used to be an attractive incentive for many business owners, but today it may no longer be the case. If you are a manufacturing company and R&D is a huge part of your operation, you can no longer deduct these expenses 100% like previously. You now need to amortize this cost over 5 years for any expenses paid inside the US and 15 years for any expenses paid outside the US. If you want to find out more about how this would affect your business, please stay tuned. Section 174 was amended by Tax Cuts and Jobs Act to require amortization of R&D expenses since 2022. That means if your business participates in development and improvement of a product or process, Section 174 study is now required because amortization is mandatory regardless of whether you claim R&D tax credit. All software development costs are now treated as R&D expenses and must be amortized, which means you can no longer deduct 100%. For example, if you spend $1 million to create a product, $1 million used to be fully deductible as expenses. Now, under Section 174, you can only deduct 20%, which is $200,000. If you use half-yearly convention, you can only deduct $100K per year. It is no wonder that you see so many layoffs, particularly in the technology space, such as Google, Meta, Microsoft, Amazon, so on and so forth. I want to take us back to the definition of R&D. This used to be a great thing for business due to its incentives. The R&D credits provide dollar-to-dollar offset against your tax liability, providing extra benefits for company to invest extra dollars in conducting R&D to create, to invent, and to innovate. What is Section 174 R&D expenses? These are typically expenses that represent research and development costs in the experimental or laboratory sense if they are for activities intended to discover information that would eliminate uncertainty concerning the development or improvement of a product. Here, I want to clarify that product does not just refer to a tangible product. It includes any pilot model, any process that you are trying to develop, any formula, invention, technique, patent, or similar property that includes products to be used by the taxpayer in your trade or business, as well as products to be held for sale or for lease or for license. In simpler terms, R&D costs are usually pre-production, meaning those are expenses that you incur before you produce something, and they are not post-production. The major takeaway for this video is for you to ask the question of whether should you be worried about this new tax law change. If you have been claiming R&D credit in the last few years, you are definitely on the radar. Even if you forgo R&D credit and don't claim it in 2022, it does not mean that you will be under the radar. We definitely recommend a Section 174 study to quantify costs that you should capitalize. Now, if you have never claimed the R&D tax credit but are in the business of conducting R&D activities such as software development, manufacturing, pharmaceuticals, custom machine building, oil and gas, electronics, chemicals, semiconductors, financial services, heavy equipment, plastics, metal processing, automotive, furniture, video game development, agricultural, medical devices, aerospace, cosmetics, food and beverage, consumer products, and fintech, you should also consider Section 174 study to stay out of the trouble with the IRS. The R&D Section 174 topic is a huge topic to cover in 5 minutes, so I hope that this gives you a little bit of introduction about it. If this concerns you, you definitely have to reach out to your CPA, and if you have questions, we would love to help you. As usual, we put in so much efforts into developing this video for you. If you can just support us by liking, subscribing, hitting the bell notification, we will appreciate it so much. Thank you so much. I will see you next time. Goodbye.